Look, it's obvious that people's portfolios are getting hit very hard right now. You've got indices that are down 10 to 20%. Small to mid-cap stocks are down anywhere from 50 to 75%. And even the large cap, these blue chip stocks out there, are down 10 to 20% really across the board just from where they were a couple of months ago. And guys, I don't care what you blame, whether it's inflation, whether it's Russia, whether it's the Fed, no matter what the blame goes to right now, people are feeling it. And there's a couple questions that are on a lot of people's minds right now. What do we do? Do we sell? Do we buy more? Like, can I even afford to buy more at this point? Seemingly everything is going up in price right now, so it's extremely difficult to make that determination on what you do moving forward. So in this video, I want to talk about a couple of different things. Whether or not you should be adding, how to protect yourself from further downside in case we see it, and really, we are in a bear market right now. This is something that not a lot of people are able to maintain their investments through. So you're not alone in this, and hopefully you find a little bit of a light at the end of the tunnel here. So if it sounds like something you're interested in, let's get started. What's up, everybody? I'm Clay. I'm here to make 2022 the best year ever. If you haven't clicked that subscribe button, make sure to subscribe to the channel. Join us, become a bro. We are here every single day, and we are growing our portfolios together. And look, if you're brand new to investing, you're not suffering on this dip yet, now could be a great time to get in. There's a link in the description for Webull. Super simple to set up your account. Any deposit right now is going to get you guys at least 5 free stocks, and then any $1 crypto trade is going to get you your choice of $5 in free crypto. And then if you guys want crypto exclusive exchanges, you have those as well. But look, I mean, you can see it all over social media. You can see it if you talk to people, if you talk to your family, if you talk to your friends. It is obvious that groceries are more expensive, that rent, that mortgage, like all the interest rates are rising. Gas prices are becoming obscene, and it's hitting people's bank accounts. So let's just assume right off the bat right now that, you know, you're in the stock market and you're thinking about you're thinking about what to do next because you're not sure if this bear market is going to continue, if we've hit a bottom, and so on. You want to protect your assets and you want to protect your profits. Now, if you're not in the stock market, pay attention too, because this could be a great time for you guys to get in and make a lot of money as these assets rebound in price. But let's just assume right now that you do have a steady income and you're not maxed out. Dollar cost averaging on the way down is an excellent idea during a time like this because it allows for you to lower your cost average, and when the assets do rebound, they will rebound. You know, when they do, you're going to see even greater gains and greater returns. What does this look like? You know, a lot of people say time in the market is better than timing the market. And that's true to a certain extent, right? I mean, if you could time the market to a T, it would be better to time the market. But if you can't, if you're looking at long-term gains, if you're not looking at intraday trading, intra-week trading, these swing trading type deals, it's going to be better if you're able to dollar cost average. Now, we're just going to leave it at that because if you can, great. If you've got that long-term mentality, great. If you can add a certain amount or a certain sum to your portfolio and average down on your positions, it will be better when you're able to go back up. But a lot of you guys are out there saying, Clay, that is impossible right now. The amount of money that I was able to dedicate to my investments is decreasing because the amount of money that I spend to live is increasing. And that is absolutely true. You know, you're looking at your groceries, they're going up 8+%. That's just based on inflation. You're looking at gas right now. I mean, it's almost double what it was just a couple of months ago. Here in Ohio, which is I know is a lot better off than a lot of other places, it's already above $4 a gallon, basically anywhere and everywhere you go. And if you're in Southern California, I see $7 per gallon plus. So if you're sitting out there and you're saying, look, man, all of my dollar cost averaging that I could have done is being eaten up by the increases in prices elsewhere. What do I do? Do I sell? How do I protect myself from the downside? Is it time to cash out my portfolio and sit in cash for a while? That is an option, okay? It is an option to cash out or lessen and shave some of your positions in order to protect your profits. Absolutely. If you're not comfortable doing that, If for some reason you don't want to sell, maybe you're holding shares like AMC and you're holding for a short squeeze. Maybe you're holding shares that are almost to that capital gain, that long-term capital gain category, and you're going to get a lot of tax benefits from holding those. No matter what your reason is, another option is to buy put options. Now, if you're not too comfortable and too familiar with put options, they could be an excellent opportunity for you to protect your assets to the downside. How they work is it's very simple. They go up in value when the underlying asset goes down in value. So you essentially have, if you buy a put option, what you're doing is you're giving yourself the option, right, to put that stock to a certain somebody at a certain price, at a certain date in the future. Now, I know that sounds complicated, so we're going to make it as easy as possible to understand. If I were to go out and I were to buy, let's just say I own Apple, I own AMC, I own one of these stocks in my portfolio, and I believe it's going to go down in value over a certain period of time. I can go out there and I can buy a put option, and if it goes down in value, that put option is going to go up in price or up in value. Now, you guys know your portfolios better than I do. Clearly, I have no idea what positions you have or how many you have, but you can do the math, and it's very easy to use an options calculator out there, but you can do the math and determine, okay, well, if this stock price continues to go down and I lose 5%, 10%, 20% on this stock position, I want to offset that loss equally or just to offset it a little bit. It doesn't even have to be a one-for-one offset. I want to offset my loss in that investment so that I am break even. No matter what is happening right now, I am break even if the stock price goes down. If you buy that put option, you're going to be able to offset your losses in case the market continues to go down and in case we see a bear market. Now, you might be looking at different expirations, different strikes, and all of that stuff sounds confusing and hard to understand. And it is. If you're a beginner, a put option can be very difficult to understand. But let's just say, for example, you expect the stock market, you expect the financial system to be very bearish over the course of the next year. You can go out there and you can buy a put option with a 1 year out expiration. If you think it might be bearish for the next 2 years, or you just want to give yourself some padded room, you can buy that put option for 2 years out. Now, I don't believe that you're going to find options that expire much beyond that, but if you're looking at that, in bear markets typically don't last that long anyway, but this can be an excellent opportunity to use as insurance on your positions. You pay a little premium to buy that put option, but it protects you from downside movement and bearish movement in the stock market. It is absolutely something to think about because look, and you might be saying, okay, well, I don't even have the money in my portfolio right now to buy a put option. I mean, basically, you can get put options extremely cheap. If you go out there and sell 1 or 2 of your positions, you're going to be able to cover the rest of your positions with that money that you gained by selling those shares there. So it's not something that you have to continue adding or dollar cost averaging down, but you will have that downside protection. So if you don't want to go to cash and you don't have the money to dollar cost average right now, put options could absolutely be a very good way to protect yourself from that downside movement or from that further bearish market. So I want to know what you guys think right now because look, we've got a lot of uncertainty. We do have inflation and interest rate talks coming up this Wednesday. Russia doesn't seem to be, exacerbating the problem they got going on in Ukraine right now. So we may be seeing a light at the end of the tunnel sooner than a lot of people expect. But hey, I mean, there's no shame in protecting yourself from further downside loss and from further losses in the stock market right now. So let me know what you guys are out there buying any put options and protecting yourself from that downside movement in the comments below. And if this button right here is still red, make sure to click it, subscribe to the channel, join us, become a bro. We are here every single day and we are growing our portfolios together. ClayBro883 on Twitter and Instagram, Webull, Binance, GeminiCrypto.com in the description below. And until the next time, hope that each and every one of you have an awesome day.